So we are ready for lesson 3.1. This is bonds. Can be confusing, so just hang in there. We're not going to delve too far into them, just far enough that you'll be able to talk about them and calculate them and maybe explain them to some folks. So the first one we do is we're looking at how to compute the price of a bond. There really are three things you need to remember: the market rate interest, the stated rate interest, and how long the bond is going to be valid or going to be out there for the public before it matures. So, first of all, we're going to figure out how much bonds sell for. So, bonds are written for a specific amount, but then are usually issued for either a discount or for a premium, and that all hinges on the market rate versus the stated rate of interest, which we'll get into later on. Let's just worry about number one, figuring out how much you will receive for a bond if it sells for 7.75, and this actually is a percent. So if it's selling for 7.575, you're just simply going to multiply 300,000 times 75.75. Same thing when it goes to being issued at 105.25. Multiply 300,000 by this 105.25, and you have the price of the bond. When it is under 100%, it's selling at a discount. When it is over 100%, it's selling at a premium. And that becomes, that premium is the interest equalizer, as was explained in the video, the overview video. So calculate these out so you can get a feel for how that works. And then we're going to do a little bit of, okay, how much cash will Durkin receive for these bonds above? So they're limited issues at 9%. They're 20-year bonds with a maturity value of $70,000. They're selling at 97, and they pay interest on January 1st and July 1st. And they amortize the bond, and it even tells you it's at a discount, right? And straight line, which is just like depreciation. You take the number of years and divide it into the amount of the discount. So, how much cash will Durkin receive for these bonds? Well, let's see what they sell for. 97? So take 97 times that 70,000, and you'll come up with how much cash they receive. And then what will be the interest payments? Now, you have to remember, even though I just received a portion of the 70,000, I'm still going to pay 9% on the 70,000. So, and I'm going to pay it every 6 months. So you can do this one of two ways. You can multiply 9% times 70,000 and divide that by 2. Or you can divide this by 2 first, the interest rate first, and then multiplies it times the 70. And it asks how much will the bond discount be. And that's going to be the 97, whatever this amount is, minus what the price was. That becomes your bond rate, or your bond discount, I'm sorry. And then they ask how much will be amortized each year. Well, whatever that difference is, let me find out what we're doing with this. Let me find some numbers. You received 900, and so that gives you a discount of $2,100, right? And then you're going to divide that by how many years? 20 years. And that is going to give you the discount rate for 1 year, or the amortization rate for 1 year. And then you would actually divide that again by 2 to get each payment, because you're doing 6 months. So 2100 divided by 20 equals, divided by 20 equals 105 divided by 2 equals 52.5, but I'd round it up to 53. So each time each time that you make an interest payment, you are amortized $53. Does that make sense? So each year that amortization is going to be $105, but each payment is going to be $53. And what is the effect of the bond amortization discount on the entire bond, or on the interest? Let's say, what is the effect of the bond amortization on the interest expense? Let's get a little more explicit there. And why do we do it? Why do we do that entry? Why do we make that difference? Because what really happens here? If it's a discount, right? What happens if it's a discount? That's what you need to go search for and think about, okay? So that's number 2. Number 3 is an interesting activity, because you're going to pick a scenario and you're going to say which is better, to borrow money or to issue stock for that money. And it's a very interesting activity that went on 2 pages, which is not fun. Let's see if we can pull that up a bit. Do we get it all? Ah, there we go. So what you have to ask here is, which way is the company better off? Now, and when you're looking at the company, you're also looking at shareholders. So which way, which plan would benefit the shareholders the most? So you need to go through here and do the calculations, because you know how to do it now. So first of all, you have a $300,000 bond, or $3 million bond. I take that back. And they're telling you the net income before expansion is $300,000. The expected income from the expansion is $500,000. Probably would help if we put some commas in there. And now, which way are we going to be better off? Here's if we issue common stock. Here's if we issue bonds. I've given you check numbers here, so you know if you're headed in the right direction. Obviously, with a bond, you're going to have interest expense. That's $3 million, and what are we having to pay? So $3 million times 6% is how much interest expense? That's going to have to go right here. And that will be deducted, right? Then that will give you your project income before taxes. Now, what you're going to have to do next is do the same thing with common stock. And that is not going to have any interest expense. So you're going to have a $300,000 net income before expected income, so that's still good, but you'll not have any interest payment to make. So now, add these up, subtract whatever you get here to come up with a net income. And what is your net income here? When you compare those two, you're going to see, well, you think it's a no-brainer, right? Well, let's take out the interest expense and keep going on this. So we've got to take 40% out. So you're going to subtract 40% of the income here, 40% of the income here, and come up with the project income. Now, you're going to add that to this $300,000, which is the standard income of the company. And you'll see, oh my goodness, my net income is much lower here, right? And it's much higher here. You would say, well, maybe plan B, but you're not done yet. You have to do the earnings per share. So you've got $200,000 earnings per share on the first one, and that gives you $246. It's a good return. When you look at the second one, though, you've increased your shares, correct? So that's only $2 earnings per share. Now, who should benefit the most from any type of expansion? And that would be your shareholders. So I'll leave you to figure out what you might want to do with that one. Now we move on to one that may be a little bit confusing, but I don't think so once we get going. You have a bond. It is issued at 4%, 10 years, and received 85% for it. And on December 2012, this is what is on the balance sheet. This right here. $300,000 less the discount, so its book value is $264. And they use straight line amortization. So here are your requirements or your questions. What's the maturity value of the bond? You should know that by now. What's the carrying amount of the bond? That's pretty obvious. What is the annual cash interest payment on the bond? Okay, what is going to be your annual payment? It's going to be that 4% times that $300,000, correct? And that will give you an annual interest payment. Now the last one is the tricky. How much interest expense should the company record each year? So you know that the discount amortization is going to affect the interest expense. What you really have to figure here is this bond is 2 years old. There's 8 years left on the remaining amortization of this $36,000. So the first thing you'll have to figure out is what is the amortization per year. So if you divide that $36,000 by 8, you come up with the $4,500. Okay, that $4,500, okay, a discount amortization is added to the interest payment, because that increases the interest expense. So you would take what your interest payment is and add that $4,500 to come up with the interest expense. And that is to compensate, okay, for the market rate versus the stated rate. So I'll let you play with that a while. And that concludes bonds. You need to remember premiums and discount rates and how they affect the interest expense of a bond. Well, email me, or message me if you have any questions, and we'll go from there. Thank you.